Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us on our last show for the year. And joining me will be Jun Bao of Tribeca Alpha Plus. And I'll be asking her about the big cap stocks that she thinks are ripe for a bit of a sell-off to take profit. And where would she be putting the money? I think the area to go is mid-cap. We're seeing rotation like that in the US out of the Magnificent Seven into smaller cap companies. And I think the same will happen here once interest rates start to fall. But I'm keen to see what Jun Bao has to say. And then we have the great Rudy Filapek-Vandyck of FN Arena. Rudy is a person that lots of the viewers of this show love to hear his views, and he's always happy to share them. So that's the show for tonight. And without any further ado, let's cross to Jun Bao. Well, thanks for joining us, Jun Bao.
Thank you for having me, Peter.
All right, so I'm going to go in an area where we don't usually go, big caps. What do you think of big caps generally right now?
Look, I think the big caps looks okay. If we think about what's in the big cap, if you look at what's in the big cap, some of the names perhaps a little bit overvalued, and others, look somewhat interesting. So net kind of look okay. We do think they have done quite well in combination over the last couple of years. In fact, some of the names has probably been the best performing, so far this year. Even thinking about CBN, the like up more than 40%. It's very impressive performance. So look, I think net they look okay. They're quality company. They've delivered a lot of return. It's just moving into next year, just a little bit harder to see them as a group to outperform. Simply because they do look a bit expensive.
Okay, let's just pretend that you are who you are, a fund manager. And you've made, for example, JB Hi-Fi, you've made 85% in 12 months. What are you going to do? Are you going to take some profit, Jun Bao, and put it somewhere else for 2025?
Yeah, look, JB Hi-Fi, I wouldn't. CBA, I might. Because I do think JB Hi-Fi, we are retailers, we are heading into a easing monetary cycle soon, right? So sometimes next year, early next year. So in that environment where consumer has been under a lot of pressure, JB Hi-Fi actually comes through pretty well. They won market share, they won new category and all of that. So they come through pretty well. So we're just heading into an environment where earnings going higher. So I would love to hold them. At the same time, you have that potential replacement cycle for PC, for a lot of consumer electronics with the new AI wave. So I just think they're well positioned. Yes, they're expensive, but they come from a very low base, in terms of share price, because everyone was worried about retailers, right, 12 months ago. So I do think I'll hold that one.
Yeah, it's such an extraordinary business. I just bought a TV a week ago, and the whole process, buy online, turn up to the shop, collect them really easily. And as I got the little reference number for the collection, I looked at the salesperson, the manager, in fact, and I said, no wonder your share price is ridiculously high. The whole process was just brilliant, and they're an extraordinary business.
That's right. They understand their customer. They understand what we need. Ultimately, if they deliver value proposition and ease of purchase, why wouldn't we go back?
Okay, so let's imagine you made a lot of money out of the banks, and let's imagine someone said to you, Jun Bao, hey, should I take maybe 10% or 15% profit? What would you say to them?
I would take 10% profit, put into something else. I wouldn't put in the cash because I think market looks okay. I don't think the share price of the banks will fall significantly. It's just not going higher. I just, put in something else.
Okay. Yeah, that's exactly what I've been telling my clients, and I'm glad you agree with me. What about an interesting one, Wesfarmers? It's also done very well as well. Would you take a bit of profit off Wesfarmers?
Yeah, I will probably take a bit of profit out of Wesfarmers and put into other retailers. There's a lot of retailers that's been sold off, bit of a hiccup recently because of how high, costs, freight costs and things like Nick Scali and others. These companies will give you more return in the year where, consumer will do a little bit better. Whereas Wesfarmers, it's done well, time to use as a funding source.
Okay. Well, part of my questions for you tonight is about, do we take some profit on big caps and we buy mid caps? And I guess Nick Scali would probably fit into mid cap.
It will fit into the mid-cap, absolutely, yeah.
Yeah. Are there any other retailers you would give the thumbs
Oh,
up to?
I will buy a whole lot of them. I will buy the AX1. Recently, share price fell a little bit because of a bit of hiccup. I'll be buying that. I don't know if you've gone to the shops yet. I went to the shops. Oh my God, all the fascination for shoes.
Yeah.
This company is actually very well positioned. I'll be just buying any day. So that company, we've got
Hang on. What shoe company did you say?
ASIC, so AX1.
AX1.
Yeah, AX1.
Okay.
Accent, yeah.
Accent. Oh, there's accent. Yeah. Okay. Good. Yep. Any
That's
others? Any others?
I also love Premier is a staple retail business. I love, a lot of time business we back the founders, right? We back Solomon Liu to run the best executing business out there. I think he's got everything lined up, doing very well, and I will be sitting in that one.
Okay. Let's go to some other big caps that the analysts still like and see if you like them. Zero. Do we take profit on Zero, or do we keep going along for the ride?
Quality company like that, don't take profit. I'll be holding it. I'll be just keep along the ride. There's a lot more to come. Not only addressable market is very strong, its cost out is really improving a lot of margin. Remember, this company only become break even maybe a year and a half ago, or maybe even only 12 months ago, and that momentum is quite large. So I'd be holding on to that one.
What about CSL, a big cap that really hasn't done well, but is a company I like, but I'm wondering whether I should keep believing in CSL.
I think that one looks okay. It sort of really underperformed every other growth company. Next year, potentially a little bit better. It's a very defensive play. I always hold it in my portfolio, but I'm probably not going to rush out to buy this at the expense of other growth tech businesses, simply because this one is struggling, going through a bit of phase where it's trying to find this identity because it hasn't really got the next leg of growth in 3 years' time. Right now, it's got a really good, cyclical recovery in terms of core business. But it's, the acquisition, the V4 hasn't really proven to be really successful. We just require a bit more time for the market to work through those uncertainties.
Okay. Now, I've been arguing that when interest rates start to fall, or we believe we're close, the market will start doing a rotation like we've seen in the US, the Magnificent Seven and other big tech stocks into smaller cap plays. Of course, here we don't have Magnificent Seven, but they are the big performers have been the ones we've been talking about, the banks and Wesfarmers, JB Hi-Fi and whatever. Do you expect to see some fund managers taking profits and then trawling through those mid and small cap companies that have suffered because of the 13 interest rate rises?
Yeah, definitely. We definitely should see the broadening out of the small caps rally now. These companies are much cheaper and they're much more leveraged, like you said, to a rate cut cycle and loosening of the financial condition. Absolutely. I think the banks is, we all heard that most fund managers don't hold much and they've been taking profit way too early. But quite frankly, I think the valuation stands at where it is. Increasingly, they will become more sensitive to a market rotation because, just simply the valuation, the differential is way too large.
Okay. So give us some names. You give us some great retail mid-cap stocks, but what other mid-cap companies have you either recently bought or you'll be chasing once you think rates are on the way down?
Look, I think that there's quite a lot of them. There's one that recently actually is being sold off. I think Seek sits in the mid-cap business. So actually, it has done well, but more recently, in the last couple of weeks, sort of has been sold off because of the tech and the people taking profit into the year end. This company actually come earnings upgrades. If you look at what's happening with the employment market, and especially if we're going through the cyclical upturn, and this one should be, a beneficiary of that. In terms of others, retail stocks is the easiest way to play. Flight Center is another one. I look at it. Flight Center itself, I think people worry about the slowdown in or collapse in the leisure. My view is that it's not a collapse. It's just not growing as fast as it was, but still very strong, very good growth. Trading at below 20 times. It's good value. Treasury Wine is another one. No one wants to buy it because China consumer is yet to come back. But remember, Treasury Wine is not a mature business in China. They're just going back into the Chinese market. So trading at the low multiple multiple it is, I do think it has a lot of potential. But especially it's got this whole brand portfolio, which is very attractive in today's world where we see a lot of M&A taking place. That's just to name a few.
Okay, one last one, Jun Bao. Is there a company out there that you've recently added that you think will be a, I remember once when you did the Son conference, you liked A2 Milk at the time, but is there a company that you think could be a real stunning performer in 2025?
I think, look, I think many of them do okay. There's this one, which I think today probably represent a good opportunity to actually look at that. I know it's expensive. It's the Chemist Warehouse. It's a Sigma, SIG. The document just came through. Scheme document just came through last week, and the share price is down a little bit. This is a incredible business with significant growth ahead, and share price down something like 7-8%. I think next year it will do. This is a short-term buying opportunity. Next year, once the business does merge, we will see how incredible this how defensive growth this business exhibit in terms of characteristics. I think that one will do well.
So would the feeling be that even though we seem to see Chemist Warehouse everywhere, there are still lots of other places Chemist Warehouse can go?
Absolutely. Absolutely. Aside from, so domestically there is some opportunity, and then internationally there's other opportunities. And remember, Chemist Warehouse is a bit like JB Hi-Fi. It's about the categories, adding different categories. So for JB Hi-Fi, remember the like for like has grown for years and years and years, right? Because every time they add a new category, it takes much longer, take many years to sort of mature and drive that organic growth. And the Chemist Warehouse is the same. And our view, if you look at the scheme document, its trading is actually very strong. So, we don't think it's a mature business. There's still got a lot of growth avenue.
Okay. And Chemist Warehouse has been totally, well, it's absorbed Sigma. So the whole Chemist Warehouse is now inside Sigma.
That's right.
Okay. Well, thanks very much for your ideas today and the ideas you've shared with us over the year. I hope you have a great Christmas. I'm sure lots of our viewers think the same of you as well, and appreciate what you've done. Have a great Christmas.
Merry Christmas, and thank you so much for having me for the year, and Happy New Year. Speak in the new year. Thank you, Peter.
And that was Jun Bao of Tribeca Alpha Plus. Now coming up is Rudy Filapek-Vandyck, founder of FN Arena. Rudy, thanks for joining us.
It's a pleasure to be here, Peter. It's quite hot outside, but I think it's cooling down in the share market.
Yeah. Let's start with the big picture, because it's been a very good year for our market, and effectively we've benefited from the tailwinds we've got out of Wall Street. But I think even Wall Street is starting to see a few challenges. What's your view 2025, Rudy?
But let's start with your first observation, Peter. I think it has been an absolutely fantastic year for U.S. equities, but we all need to take into account the fact that this is probably going to end up one of the best, if not the best, performance of U.S. equities in 30 years or something along those lines. But it also has been amongst of a very narrow base. And from some people who pay attention to these things, they haven't seen a market that has performed so strongly as this year, with so few stocks that actually outperformed the index in the US. Depending on how the next few weeks are going to pan out, the US might end up with 30% gains this year, which I don't think too many would have predicted at the beginning of the year. For us, it's okay as a year, I guess. It's probably a little bit above average. I think we're under between 9 and 10% plus dividends, I think, so far. But we also have had not as narrow as the US, but it was quite a narrow base. And many investors who, for example, have put their money with resources or with micro and small caps, they haven't seen those rewards. So The hope for next year is that we will still have a positive year, but that the base will broaden. And I'm not so sure whether that's going to pan out exactly as everyone is hoping for, because there's a few things that people are hoping for. One is that the gap between the US markets and the rest of the world has, according to some measurements, has never been as wide as this year. And then the hope, of course, is that that so-called US exceptionalism is going to disappear next year. And we have markets, not just Australia, but markets amongst the emerging markets in Asia, the markets in Europe, in the UK, that they finally find a way to close that gap and to maybe outperform the US, and then everyone will be happy and smiling again. I think maybe next year might not be the year for that yet. And the reason why I say this is at the very least, you can make the argument that the US has strong earnings growth. And they obviously are at the forefront of, yet again, the technological megatrends that we are enjoying here, the AI and the GLP-1s, cybersecurity and the likes. And unfortunately, Europe, nothing happening there so far in terms of earnings growth. That's why the ECB will continue to cut, I believe. And Australia, unfortunately, we have to conclude as well that while the share market is up this year, earnings growth, there hasn't been much. We also have a very narrow base when it comes to earnings growth. And those stocks we know, those companies we know, they have performed absolutely fantastically. It means it's the Hub 24s, it's the Goodman Groups, it's the WiseTech Globals. This year, also the banks. And I think that's more driven by size and by the fact that they are paying out a lot of money to shareholders and buying in their own stock as well. But there's not much happening there either in terms of real earnings growth. So Australia needs something next year. And so let's keep the fingers crossed and the RBA starts cutting in as early as February.
Okay. Well, let me do something very risky, and that is ask you to assess the strategy that I've been using ahead of 2025.
Okay.
And that strategy has been where America, they talked about the Magnificent Seven. I guess we could talk about the bloody beautiful banks, which have had a sensational drive and have helped the market go up, of course. So I'm saying to all of my subscribers and financial planning clients, well, let's take a bit of profit off those banks. And let's go for resources. Keep our fingers crossed that China improves over the year. I've also been recommending something called X20, which is a new beta shares product, which gives you the stocks 21 to 200. So it's the ASX 200 minus the top 20. But I put in I buy BHP and Rio, so I get some of the top 20 I want. I've actually noticed that, clearly CSL is a top 20 company I might want to buy as well. But you can see what I'm saying. There's a core of great companies which I think have done unbelievably well. JB Hi-Fi, be case in point, up about 85%. Fantastic company. But it seems that if I was a fund manager, I would be trying to take some of the profit and looking for the companies that will benefit when interest rates eventually fall. I know you always love punching holes in my radical strategies, but what do you think, Rudy? What do you think, Rudy?
Well, I'm ready to punch holes, Peter. Listen, at face value, I think that is pretty much what I was referring to earlier, and I think most of the research reports, most of the strategy reports I'm seeing across my desk here, that's basically what a lot of people are hoping for, that the stocks that have the markets and the stocks, the companies that haven't performed so far, they might get their chance next year. My main pushback against that, and it's not really a pushback, but it's something that I think investors need to take into consideration while they probably are going for that strategy. It's okay, I think, to take some profits off from the stocks that have performed so far. Because some of those stocks, the Hub 24s, the WiseTech Globals, I mean, they're up by sometimes by more than 100% in quite a limited amount of time. I mean, I wouldn't have guessed, forecast, whatever, that Technology One would double this year, all right? But it has, all right? It's up 100%. Now, I can see the logic to take some off the table. Where I would be more hesitant towards, in my advice to investors, is don't abandon these stocks altogether. Because while they have performed really, really well this year, and they might suffer a little bit from funds outflows when portfolios rebalance all of that, the outlook for those companies is still very, very solid. So the best reference I could make from a personal experience is that in the second half of 2016, which was not probably not by coincidence, also when Trump was elected the first time around, that a lot of money flew out of those companies, and they briefly were out of fashion. It all flowed into commodities and was also into value stocks. But 6 months, 9 months, 12 months down the track, those stocks were back on a very strong and uptrend, which has lasted until today for many of those stocks. So be careful that you don't mix up short term with medium and longer term.
Yeah. Okay. Let's look at some big caps that have done very well, and ask the question, do we have take the courage to take some profit and go somewhere else? Now, we'll leave the banks out because the banks have done really well. And I suspect when rates start to fall, the fund managers will start taking a bit of profit. But what about a great company? And we'll leave one of your favorites, Pro Medicus, which probably underlines how great you are as a tipster. I'll ignore the ones you got wrong, Rudy, but Pro Medicus, you have been on board that one for a long time. And it's no wonder you recently got married, because that lady must have recognized you're a brilliant stock picker and she had to be with you. Or vice versa. You probably learnt from her. But the bottom line I'd like to know is, look at a great company like Goodman Group. It has been a fantastic company ever since you and I ever started talking on TV. You look at the chart, it keeps going up, going up. Yeah. Would you buy Goodman now, or would you basically just hold it and not sell it?
Well, I am a shareholder in Goodman, and until recently, I think it was one of my largest holdings. But that's also because it grows so much. I'm a firm believer in Goodman. I think this is why I made that reference earlier. I can see the logic in taking some money off the table here. Goodman Group has outperformed most expectations. I mean, I know of fund managers who started taking profits in the early 30s of the share price. It was almost $40 recently. So they were very early. I can see the logic here, but in the same respect, I also have to emphasize this company has a lot more growth under its belt. It's a very well managed company. The mega trend of data centers and investments in data centers is not going to go away anytime soon. So I can also see the logic that you either take the volatility on board and just stay the course, but whatever you do, don't sell out completely out of Goodman, because you might be surprised by how quickly those share prices start rallying again, and they might simply rally away from you, and you're going to regret it.
Yeah. Let's go to Macquarie now. My biggest holdings. I've never had the courage to sell it, and I'm glad I haven't. But I am wondering, particularly if America starts to, slow down, because it's benefited from the US growth. What's your view on Macquarie at this point in time, Rudy?
I think you need to try to get to the core of what moves companies like a Macquarie, and I think and that's almost by definition going to be true. The Trump presidency is going to unleash, I think, a whole wave of mergers and acquisitions in the US. One of the main beneficiaries will be Macquarie, and I think on the ASX, that's why you own Macquarie. Of course, there is the talent they have, the history, the track record, the culture. But what they need is a very fertile environment for buying and selling assets, merging them, IPOing them, all of that. That is the preferred hunting ground for Macquarie. So definitely stick with Macquarie.
Yeah, okay. What about one of our great tech companies, namely Xero? All right. Do we stick with Xero, mate? I know the analysts think there's like an average 16% upside. I think they all like it. Maybe 1 out of 5, maybe 1 out of 16. I'm a Xero fan. What about you?
Yeah, absolutely. Again, I think a company like Xero is heavily underestimated by Australian investors. Australian investors are not used to companies like Zero that once you're a customer, you're unlikely to leave.
Yeah.
And they focus way too much on the fact that they service smaller cap businesses. What companies like Zero do, and which I've learned, for example, from a Technology One, is that it's not just that they keep you as a customer. They over time they sell more products to you, and that's obviously why the continuous growth constantly comes from. So this Zero, I can see some logic in maybe scaling something back here because the share price has performed quite well. But in the same respect, and if you're not on board yet, wait for the pullback and just pick your entry point.
Yeah. What about Next DC?
Yes, well, I'm a big shareholder of NextDC, big fan still. It's more volatile than, for example, a Goodman Group. That's also because a lot of people don't really understand that REIT infrastructure story. But I hope investors were on board and they've taken up all the extra shares they could in the recent raisings. And I'm with Morgans on this one. They think the share price can reach as high as $30 in a few years' time. It's 15 now, so draw your conclusions, I would say.
Yeah. Let's go to some smaller ones now. Is there a mid-cap company that you think, if you've kind of agreed in principle that we probably will see some profit taking from mid-cap, and the fund managers will be trawling through those smaller cap, mid-cap companies that will be beneficiaries of lower interest rates. Now, one I won't ask you about is Tyro, because I always ask about Tyro, but I do think it's a company that will probably benefit from lower interest rates and more people going to pubs and cafes and stuff like that. But I use that as an example of the thinking. Is there a company that you think has struggled because of the interest rate environment, the slower spending from people with mortgages, that you think will be a beneficiary of the next cycle as interest rates come down?
I'm not sure whether, but I mean, I'm a shareholder in Data.
Yeah.
That's more small businesses than it is households.
Yeah.
But I do believe that a lot of small businesses, obviously, they have been struggling as well, and they still are struggling.
Yeah.
I think that's the reason why I think the share price has been held back a little bit. For people who are looking to benefit from the mega trend still, which is AI, and that mega trend is going to go on forever, and do not necessarily want to go directly into data centers and the likes. If we are start buying PCs, laptops, mobile phones with AI on it, Data will be one of the main beneficiaries. It will not be just about JB Hi-Fi and Harvey Norman. So from that perspective, they pay a reasonable dividends, and they have a founder-led track history. Share price hasn't done too much in recent times, but I do believe it's one that at some stage will completely awaken and take people by surprise.
I know when I interviewed the CEO, he's an outside the square kind of guy, isn't he, Rudy?
Yes.
You couldn't help but think, but he does so well. His company does so well against foreign rivals. He'd also be a takeover target, I would have thought, if your scenario.
It is well possible. From memory, they are the number 3 in New Zealand and the number 2 here, I think, or number 1 here. So they are. I mean, if there's anything that needs to be distributed in terms of laptops, PCs, chips, microchips, software, I mean, they are always at the forefront, of course. Yes.
Okay. So as people get more money with lower interest rates, I suspect travel will become more popular for that group. Is there a travel company that you think looks like good value right now?
I'm going to name one probably that you don't hear that very often. It's called SiteMinder.
Yeah.
And it's a New Zealand, for origin from New Zealand. Again, New Zealanders, they generate quite some decent technology companies. Zero, for example, came from New Zealand.
Yeah.
And they're rapidly developing into a highly appreciated services provider for accommodation, basically hotels, small hotels, large hotels,
and things. Yeah.
They're not profitable yet. That's your risk, but they should not be too far off if they can continue growing as they are. And the share price has actually done quite well this year, and you can see the momentum and the enthusiasm amongst brokers who cover the stock. You can just see it accumulating almost similar to what happened with Life 360 about a year ago.
Yeah. I can remember there's a company which, you know, Bailador, I think was an early investor in SiteMinder. And I remember when he described it, the former New Zealand All Blacks halfback, what was his name? He was also Fairfax CEO as well.
Ooh, yes. But you're probably more qualified to
yeah,
answer.
no, my rugby knowledge is letting me down on this. But I remember he described it at one of our conferences, and I thought, this is an impressive sounding business. One final one before I let you go, mate, and wish you a Merry Christmas. The resource play, okay, you didn't pick up and say, Switch, you're wrong, trusting China to come good over the course of the year, which made me probably think that you probably think there's a 50-50 chance China will actually do something positive this year. Is it a silly play to believe that BHP and Rio can have a pretty good year?
No, because those share prices have come under pressure. It's a bit of a one hand and two hand reasoning. On one hand, I think even those companies themselves will be a little bit skeptical in how long iron ore can keep up above $100 a ton US. But on the other hand, they have lots going for themselves. One is copper, of course.
Yeah,
and copper will awaken at some point. Might be a little bit early, but it will happen at some point. BHP, of course, is working very hard on their potash expansion, and aluminium and alumina and lithium on the Rio side, which also again is now going through a very nasty and elongated bear market. But that too will resolve itself at some point. Might be 26, might be 27, but it will happen, and they will both be beneficiaries from that. Yes.
I can always remember when we're doing the Sky Business program, it was Michael McCarthy, if I remember rightly. BHP, remember BHP fell to $14, and I remember saying to him, "Look, are you going to tell me that within 3 years it's not going to be 20? If I can make $6 on 14 over 3 years with a great company, it seems like a good bet." Well, it made 20 by the end of the year. So when these things take off, and we recently saw, you know, when that Chinese recovery story came out, all those miners went up, didn't they, straight away on that day. So the more believable the stimulus, the more likely we'll get a market lift before they even produce great results.
I believe so, yes. I do believe that the Chinese will, if they can, they will wait until they see further signals from the Trump administration about what to respond to. Yeah. So it may take a while, but I am with you. The Chinese economy is not in the best states. And stimulus will be forthcoming. Yes.
Yeah. And in many ways, Donald Trump might make Beijing actually push money just to outperform all expectations. You can imagine them thinking that. Because that was supposed to be the last question, but I never have a last question with you, Rudy. Lithium. What do we do? Do we take a punt on Pilbara and IGO and just wait, or do we wait and buy later?
It's a bit like uranium. It's the same proposition.
That's my last question.
Uranium. There you go. I'm surprised by how savage this year the share price has been for the likes of Paladin and some of the other ones. Now, clearly, when you ramp up a mine, even if it was on care and maintenance, it's more complicated than I would have thought, but it has been proven. But in both cases, particularly in uranium, that story isn't going to go away anytime soon. Those mines will come into production, even if it's a bit delayed or a little bit more troubles. So if you're sitting there, I mean, the best thing I can say is you wait, because as you say yourself, and as history shows, if good times arrive, those share prices double, triple, quadruple in no time. But in the meantime, you don't know how long the wait can possibly extend into, and that's the dilemma.
Yeah, but I'm going to put you on the spot. Pilbara, IGO, Liontown, which one would you buy if you're in a buying mood?
I'll give you another one. I would buy Arcadium.
Yep.
For the simple reason that the shares are still at a sizable discount to the offer by Rio. And I do believe that acquisition will go ahead, so you get free money.
Okay.
And
Paladin.
otherwise, I'll pick Pilbara.
Okay. All right. So first comes Acadium, then Pilbara,
Yeah.
and then Palladium versus Boss Energy.
Paladin.
Paladin, PDM.
Yeah.
Well, Rudy, thanks very much. As always, great catching up. Our viewers love you coming on the show. I don't like praising you too much, but you do deserve it. We do appreciate it. You have a great Christmas. I look forward to talking to you in 2025.
Absolutely. And you too, Peter. Thank you.
My pleasure. And that was Rudi Filapek-Vandyck, the founder of FN Arena. That's the show for this week. Thanks for joining us. I'll be seeing you in the new year. We'll be back around January 20. You have a great Christmas. Happy New Year. And I'll see you then.